In practice, it's actually pretty straightforward to do this. What I need to do is I need to go onto a financial database like Bloomberg or Trace, and I need to look at the bonds for the company that we're trying to value. And I want to look at the bonds and I want to try to establish whether each of the company's different bond issues has a recent trade. And when I say recent, probably okay, as long as nothing weird has happened in the economy, you're probably okay with a bond trade within a week or two, maybe even a month if there's something pretty close and again, nothing crazy has happened, right? I don't want a bond trade from January if we're sitting right now, because that's not going to reflect anything of what's gone on in the last 2 months. Okay. So I go on here, and remember, bonds don't trade that often, so I can look at a list of all the trades that have happened, and I'll be able to probably see 20 or 30 trades stretching back maybe to like the previous year, and I'll be able to see if there's been any current trades, what the price was, and then what the implied yield was based on that price. And that's my cost of debt, that's the yield. So if I can find that, I'm in great shape. So let's look at this. This is UPS trading data for their 4.875 bond that's due in 2040, right? So this was a 30-year bond. Remember, we're doing our UPS analysis in 2013. So there's 27 years left on this bond. We can look at the trades that were recent in December. So December 27 in 2013 back to December 6 in 2013. Now there's a couple of idiosyncrasies in the bond market when we're looking at trades that we'd have to be aware of. And one of them is that we only want to look at big trades. So we're only looking at trades that are, say, bigger than $1 million, with some caveats. And the reason is because of the liquidity issue in the bond market. Because there isn't any liquidity, lots of weird trades happen, what we call establishing trades. And they happen because, let's say, a bond hasn't traded in 6 months, but I want to buy or sell it now. We don't have a current price. And remember, price is based on the current risk and the current market reaction and the current risk-free rate. And all those things have changed in the last 6 months. And so the only way for me to get to sell the bond is to try to establish what the correct current price is. And the only way for me to do that is to actually sell the bond, right? The only way to find what something is worth is to sell it at that value. So what happens is, because so much time has gone by, or because something unusual has happened to adjust the risk of the security, bond traders will do what are called establishing trades, which is when they sell a small amount of the bond back and forth to each other to try and figure out what the price should be, right? So you'll say, oh, I'm going to post, I want to make a big trade in UPS debt. I'll put a little bit out on the market. I'll see what somebody's willing to buy it. Then I'll buy it back, and we'll have established a price. Okay. So let's look at the timeline here. On the 6th of December, we had a pretty sizable trade, 300,000 at $103.25. That implied a yield of 4.6, right? Remember, prices and yields go in opposite directions. So if I paid more, $103, again, 103, I'm getting caught up in the quote. 103 is 103% of 1,000. Okay, so if I paid 103.25 for a bond that had a 4.8% coupon, I'm paying more than it's worth. That means yields have fallen in the market. Right, so a yield of 4.6. And then on the 10th, we had $1 million trade at 104. And again, price went up again, so the yield falls again, 4.5. This is the relevant trade. If I'm doing my analysis in December, this is the trade that I can pull and say, okay, that's a current trade that's big enough that it's a true trade. It's not an establishing trade. It's not an information trade. This is an actual trade between two people. And that's the current price. That's the current yield. And I can pull that out. Right? Look at the next 4 trades, though, on the 27th of December. They're all for $7,000. And look at the timestamp. They all happen almost immediately. Right? So those 2 trades on the 27th at 9:05, they happen immediately. So somebody sells 7,000, then buys 7,000 at exactly the same price. And then a couple minutes later, we have trade at 9:13 and 9:14. So within 20 seconds of each other, again $7,000 at a slightly higher price, 102.08. Right? The reason why we can't use those as our trades is because they don't actually convey the information we think they do. They don't convey the information that is contained in a true trade, because it's just two people selling $7,000 of UPS bonds back and forth to each other to try and figure out, because no trades have happened in 3 weeks, right? The last established trade was 12:10. Now we're 12:27, so 2.5 weeks have gone by. Nothing has happened. Maybe things have happened in the market. We're trying to figure out what the correct price is going to be now. And notice that the correct price is significantly lower than the trade that happened on the 10th. $3 less, and the yield is now significantly higher. So something happened. We're trying to establish what the correct price is going to be. So we're making all these tiny, small information trades, trying to figure out what the price should be so that we can make an actual trade. Okay, so we got to be careful. Again, this is just idiosyncrasies of the bond market, and it's because the bond market is not centralized and is very opaque and illiquid that we have these things. So we're looking for big trades that we know are true trades. Now you can see here what happens when we have an issue of a critical liquidity issue. And so let's look at some Procter & Gamble versus Home Depot bonds, right? To see what happens when we have bonds that don't trade very often. Okay, so this is our Home Depot bond, our 5.875 bond that matures in 2036. We can see that Home Depot bonds actually trade pretty often. This is you can see that there's on the 17th of June there was like 6 trades. On the 18th there we have 3 trades reported. We have some sizable trades and some information trades. So on the 17th there's a $4 billion trade, $4 million trade, a $5 million trade. There's a $400,000 trade. All happened on the 17th. And then on the 18th there's some small ones, 10,000, 10,000. Those are right after each other, a second apart. So those are definitely establishing trades. But then a sizable trade of 214,000. So that's at least semi-reliable, especially given that we had big true trades the day before, right? So this is pretty unusual. This is a lot of activity in the corporate bond market for a single bond issue. For a difference, let's look at Procter & Gamble, right? Now this is the same number of trades. There's 10 trades here, but instead of happening over 2 days, they happen over almost a month and a half, right? So the first trade is May 5th. The last trade there is June 17th, right? Which is when the UPS one starts. Okay? So we could have looked these prices up, say on June 18th, and we said, okay, give us the last 10 trades that happened. Well, for UPS, they all happened in the last 2 days. For Procter & Gamble, they all happened in the last month and a half, right? And what's important to note is look how drastic the price changes and the yield changes have been for UPS. I mean for Procter & Gamble. And I say drastic, I'm being a little over exaggerating here, but the price changes are pretty significant. So the trade on the 5th, and which was small, admittedly, 50,000. Those were probably again establishing trades. They happened within a second of each other at a price of 111. So that's $1,111, right? Remember, a percentage of 1,000. Then the next trade happens on the 6th. Again, we see a small trade, and we see on the 7th we have some small establishing trades, 3 of them for 25,000. But at that point, and this is a couple days later, the price has jumped up to 120 almost, right? 119, 117. So that's now 1,200 instead of 1,100. That's a $100 price change. That's a pretty significant change. Now these are all still information trades. Then nothing happens. No actual trades happened, right? This was people trying to feel everything out, feel the market out. They weren't happy with where the prices were, so they never actually made any deals. Then we wait a week, and now we're on the 15th or the 13th of May, and we see, okay, now a price, a couple more establishing trades at like 113, right? And still nobody's happy with that, and we wait a whole month, and the price goes back up to 117, and we see a pretty sizable trade, $500,000, right? So we could probably rely on that. And then a couple days later after that, or a day after that, we see a big trade, $4 million at 122. So think about how we interpret this if we're trying to get the cost of debt for Procter and Gamble, right? 2 months ago, the price was 110, so $1,100. And that wasn't, we don't consider that to be a good trade, but that's the information we have. Whereas today, or if we're on 6/18, yesterday, we had a $4 million trade at 122. So in the space of a month, we had a total of 10 trades, of which 2 are probably actual trades. The rest are just market feelers. And in the space of that time, despite all that, we've seen a price change of like more than 10%, even though there were only 10 trades. Okay? So this is why we can't rely on these smaller trades, because we don't know what the information contained in them actually is. Nobody ever actually made a deal. They just were buying and selling these small amounts back and forth to each other, trying to make a deal. So if I was in May, could I rely on this 110? Well, if I waited till mid-June, I'd realize that I was pretty off base, right? That the price that was established in those small little trades was actually incorrect. I'd have to go back and try and find a bigger trade, and I might not find a bigger trade until keep it going back until March. So if I'm doing this analysis between March and June, what's the appropriate yield? What should I be using? And the answer is, we don't really have a good answer, right? We're going to have to try and estimate it. We can't use the best way, which is to find the current price and get the current yield based on our formulas. We're going to have to figure out some alternatives, and those alternatives, they're not going to be as accurate, and so we don't prefer them.